Good morning from Chicago traders. It's 8:01 a.m. Chicago time on Thursday, the 8th of January 2015. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. Interesting movement overnight. A quick rundown. This statement comes from TradeTheNews.com. I tend to like to use it because it's pretty succinct. Equity markets opened sharply higher amid gains in the U.S. and Tokyo as dealers assess FOMC minutes and comments from Fed's Evans. Fed's Evans came out yesterday at approximately 5:50 p.m. Central Time. The comment from Evans is that he does not believe the Fed should be in a hurry to increase interest rates. He is a dove and a voter. He says a policy liftoff should not occur until 2016. Raising rates would be a catastrophe. Fed should be patient about maintaining stance of current policies. Fed needs to provide appropriate amount of accommodation to hit inflation goal. Inflation outlook is more worrisome. Very concerned about low inflation. See it staying below 2% goal until 2018. That caused a little pop. In the overnight, the market moved from approximately 2075, 2021 in the ES and shot all the way up to 2038. So approximately a 17-point run yesterday. Greek markets open higher amid lower bond yields and speculated debt renegotiation talks. Oil producers rebound. Friday's U.S. payrolls report remains in focus. Corporate bond issuance picks up. That's basically the rundown of overnight. Again, the goal with these trader bites is to reduce them down to end by 8:15 Central. U.S. initial jobless claims came in at 294,000 versus 290,000. Continuing claims at 2.452 versus 2.36. So both numbers were higher or worse than expected. Small jiggle on those numbers in the ES. Basically a bar in the range of 37 to about 33 on that release. Looking ahead, 9:30 weekly EIA natural gas inventories. Treasury announces that's at 9:30. 10 o'clock, Treasury announces the size of upcoming 3, 10, and 30-year notes if you're a curve trader. Fed's Rosengren is expected at 11 Central. At 2 p.m., we have U.S. consumer credit expecting 15 billion. That's a low importance number. And then we're clear until about 7 p.m. this evening, Fed's Kosher Lakota on monetary policy. And then at 7:30 this evening, we have China's December PPI expecting negative 3.1% and CPI expecting 1.5% year on year. Let's look at the technical picture here and go over what has happened yesterday, what it tried to do, how good of a job, and so on. So yesterday's hypothesis was for a test of the overnight high. Let's look at the overnight chart. So this was yesterday's overnight high at 14.25. The idea yesterday was that we're likely to push to chop around on the open. That's the primary hypothesis. Chop around on the open and just wiggle around. But overall, I had cautioned bears on Tuesday night on a tweet from the S5 Trading chat room, stating that if you're strongly bearish, you might want to be careful as the market is shaping up to push higher in yesterday's session. Took a while. wiggle, jiggle, and chop here in the in range, in and out of range, and then finally we get a strong rotation up, 12.75 points, which also created an interesting dilemma in that it just took forever to continue the impulsive move here. So in the short term, we did have a small continuation, small pullback, small continuation, but I was looking for this impulsive move from 0475 to 2375 to have its continuation. If you recall from yesterday, the target upwards, the primary target upwards was this this LVN right here at 2350, and then 28 was the next key target up. So if I compress this chart and look at the volume at price in the zone, you can see the area we're trading. And so the idea yesterday was that we would move away from this high volume node. I know this is not very clean, so to speak, because volume is not by its nature. But what I was looking for is to move from this high volume node here in a normal auction pattern to the next high volume node, which means that we need to clear this 2350. So early on you saw a push to 23-ish and then a pullback. That's the reaction that the LVN is expected. And then the expectation was for a pullback given the impulsive move up, for a continuation up through 28 to hit the high volume node in this area right here at 28. And then expected it to chop around here and close in this area. Did not accomplish that. It just chopped lower and was stuck in this lower HVN zone. But the normal pattern, so to speak, the prevailing or probable pattern is once you clear the LVN for the high volume node to be next, which is 28. And then once we clear the high volume node, the low volume node beyond that at 31 with a deeper low volume node at 34. And that was my target overnight, actually, at 34.50. I put that on Twitter late at night. And what the market's done on the news and the action overnight is it actually pushed through to one more HVN node. So the key element in this area here is the 46, 75, 48 area. That's the next key area up. If we look at the overall action, we'll see that the midpoint of this move up was 36 or so, which to me coincided with that 34 area. So I was looking for the market to react to the downside once we get up there. There's an LVN at 34. The mid of this last swing, RTH only, is at 36.50. I was looking for some resistance in this area. The market's trading 35, 36 even. So this morning, let me switch back to the 15-minute here. So this morning, my primary hypothesis is for responsive selling. I expect the market to struggle here to take out the overnight high. I expect it to get responsive and pull back and test this 28.75, 28 high volume node back here. So on Tuesday night, I did call, whether you saw it or not, I did call out for a pop higher with a 28 target. We got the pop higher. It was very slow trade yesterday. We did get some range, 19 points, but we didn't quite push to 28 simply because, to be honest with you, that was an oversight on my part, because 28, given the low that it was putting in, would have been very difficult to accomplish statistically, since the IB to high on an up day is approximately 15 to 16 points. And that's so the 28 was well beyond that. It was in the second sigma or second standard deviation range, and so would have been we would have needed the Evans news during the day for that to happen. However, the pattern that I look for, which is this impulsive move, pullback, consolidation, and then continuation, the pattern itself did work out, as you saw here. Impulsive move up, so that I'm looking for this move. I'm predicting the probability of this move with that hypo 1, and then I'm looking for a pullback, which we had 2014 solid gold on that level right there. 2014, that was high the prior day, but I've been calling for 2014 now since last week, or a couple weeks. That was the over-under line. That was the line that folks needed to, the buyers needed to hold, regain and hold to start pushing back up. That would have been probably an option strike price for me in that area for a hedge. It got tested multiple times, 1350 and 1375, and then we finally got the continuation on that impulse by creating a second impulsive move, consolidation all night, and then the continuation move all night. Same pattern repeats all the time, most of the time, and it's playing out today. So today, looking for responsive selling. I'm seeing resistance here. Looking for responsive selling back into the 28. Once we get to 28, expecting chop back and forth. This is a high volume node, so the expectation is for chop, and then the market's likely to resolve itself. If buyers want to step in, that would be the ideal area, in my opinion, to step in. That's my primary plan. Real quick, before my 15 minutes are up, I want to go over the fundamentals chart. We could see here that the New York Stock Exchange new 52-week lows really rose pretty well on the sell-off in December, but has really flattened out and dropped pretty hard with the new 52-week highs on New York Stock Exchange coming back up and showing strength again. For those perma bears and those who insist that the market should go down and that it's stratospheric and it's ridiculous and whatever other emotional opinion you might have, emotional or not, I shouldn't judge that. Just be careful. The market's got pretty good underlying to keep going. These are the 5 main sectors, namely the XLV is the healthcare sector, a very strong since the start of this chart, which was in March of 2011. It's up 109%. XLY follows, which is consumer discretionary, and then you look at you see XLK, which is the techs, XLI industrials, and XLF, which is financials. But all of these are turning up right now, and you want to be cautious. These are not moving averages. These are indices of the that represent the lion's share of what the S&P 500 contains in it. Again, Euro stocks, I neglected to comment on them yesterday while we're at the Trader Bite. This impulsive move here, I wanted to discuss this. The impulsive move left a double distribution at the open. I was looking for 56 to be tested and 3070 next. This area here, 3063, 3070 in the Euro stocks. Why am I talking about the Euro stocks? This product's becoming more and more popular. The Euro stocks are relatively cheap to trade. They represent 50 stocks in the Eurozone. They're relatively cheap to trade, and they trade much like the S&P 500. They hold their levels pretty well. They're very liquid, and with the CME data fees and so forth, I feel like more and more people are having a hard time affording their feeds and so forth. And I think Eurex is a much better alternative, to be honest, than the CME for those people who want something else to explore. Also, they're most active overnight and early in the morning and through to 11 o'clock, so they're convenient for those who have a day job while they learn to trade. So this is a decent product. Was looking for 56 tests. We got 57 on a double top, and then it did complete the impulsive move up here. And then today, coming in, the expectation was for it to test this midpoint from the high. So I took the midpoint. I'm watching midpoints all the time, or the 50% pullback from the high at 96. It got to 95 before the pullback to the intraday mid, the session mid. I think it's going to have a hard time taking this out this morning. Again, in line with the hypo for the S&P. The Bund pulling back, but it held a trend line I drew yesterday, this morning, but it's breaking through it. I think the Bund's likely to test 156.86 again, as the Euro stocks are likely to pull back and be responsive, along with the S&P on the open. The expectation is for the Bund to start moving back up to 156.86, which is the MC point of control. I'll leave you with those thoughts. I won't cover crude. I want to keep this short. Good luck to you, and I'll catch you tomorrow. Don't forget, non-farm payrolls tomorrow morning. Take care.